Free trade. Buying and selling of goods internationally. Free trade agreements eliminate tariffs, enabling businesses to access international markets and reduce production costs. Free trade policies often encourage innovation by fostering collaboration between companies across different countries. Joint venture. Two or more companies develop a new entity. Joint ventures are particularly common in industries like technology and automotive, where innovation requires substantial investment. A joint venture agreement should clearly define the roles, responsibilities, and profit-sharing terms for all participating entities. Corporate culture. The beliefs and ideas that a company has. Corporate culture significantly influences how employees interact with clients, shaping a company's reputation in the market. Leadership plays a pivotal role in shaping and maintaining corporate culture through actions, policies, and consistent behavior. Monopoly. Exclusive control over a product or service. When a company gains a monopoly, smaller competitors often struggle to sustain operations due to unequal market influence. Technological advancements can disrupt existing monopolies, providing opportunities for new players to enter previously unchallenged industries. Hierarchy. A system where people are ranked one above the other. Rigid hierarchies can hinder decision-making processes and make organizations less adaptable to rapidly changing market conditions. A well-structured organizational hierarchy ensures clear lines of authority and responsibility, promoting efficient communication within large companies. Startup. A newly established business, often in the tech sector. Innovative ideas and efficient execution, crucial for a startup to gain traction and establish itself in competitive markets. Many startups struggle with cash flow issues, especially during the initial phases of product development and market entry. Entrepreneur. A person who starts and manages a business venture. The entrepreneurial spirit drives economic development by fostering job creation and promoting technological advancements. A successful entrepreneur combines innovation with risk-taking, driving business ventures toward profitability and sustainable growth. Subsidiary. A company controlled by a parent company. Multinational corporations establish subsidiaries to operate locally while complying with the regulations of specific countries or regions. Parent companies monitor the performance of subsidiaries to ensure alignment with overall business objectives and profitability targets. Niche market. A small area of trade within the economy. Success in a niche market requires businesses to deeply understand their target audience's unique needs and preferences. Luxury brands thrive in niche markets by catering to customers willing to pay a premium for exclusivity and quality. Inflation. A rise in prices, making money worth less. The cost of raw materials skyrocketed due to inflation, putting immense pressure on small businesses to remain competitive. High inflation creates uncertainty in financial markets, discouraging long-term investments from both businesses and individual stakeholders. Negotiation. Discussion aimed at reaching an agreement. In international business negotiations, cultural awareness plays a critical role in building trust and avoiding potential misunderstandings. Successful negotiation requires understanding the interests of both parties and finding common ground to achieve mutually beneficial agreements. Bankruptcy. A legal status when someone cannot repay their debts. Many entrepreneurs view bankruptcy as a setback rather than a failure, often using the experience to rebuild stronger companies. Bankruptcy laws differ significantly between countries, influencing how businesses approach financial difficulties and debt restructuring. Customer retention. The fact of keeping a customer for a long time. High customer retention rates indicate that a company is meeting customer expectations and delivering consistent value. Regular engagement through personalized communication strengthens relationships, leading to improved customer retention. E-commerce. The buying and selling of goods online. The rapid growth of e-commerce has transformed retail by offering customers the convenience of shopping online anytime, anywhere. Supply chain efficiency directly impacts the profitability of e-commerce operations by minimizing delivery times and reducing logistics costs. Layoff. Temporary or permanent removal of employees from jobs. Large-scale layoffs can negatively affect employee morale, reducing productivity and increasing turnover among remaining staff. Companies should provide adequate support to employees affected by layoffs including outplacement services and severance packages. Recession. A period of significantly reduced economic activity. Economic recessions typically result in reduced consumer spending, increased unemployment, and slower business growth across industries. Prolonged recessions can lead to significant structural changes in industries, forcing businesses to innovate or exit the market. Merger. A combination of two things, especially companies, into one. Mergers between large companies often face regulatory scrutiny to prevent monopolistic practices and ensure fair competition. Cross-border mergers involve navigating complex legal and cultural challenges while striving to create a unified global entity. Brand equity. The value and strength of a brand in the market. High brand equity can act as a competitive advantage, making it easier to enter new markets or launch additional products. Strong brand equity allows businesses to charge premium prices and maintain customer loyalty even in highly competitive markets. Supply chain. System of producing and delivering products and services. Sustainable supply chain practices are increasingly essential to meet environmental standards and appeal to eco-conscious consumers. Supply chain disruptions during natural disasters highlight the importance of contingency planning and diversified sourcing strategies. Solvency. Solvent condition, ability to pay all just debts. Effective risk management strategies help ensure solvency, even during unexpected economic downturns or market disruptions. Maintaining solvency requires businesses to balance debt levels and generate sufficient cash flow to meet their financial obligations. Liability. Legal responsibility for something involving financial obligations. Companies often purchase insurance to protect against liabilities arising from accidents, errors, or unforeseen events. Businesses must address potential liabilities to avoid legal disputes and financial losses arising from negligence or regulatory non-compliance. Acquisition. The act of obtaining something, especially a company. Hostile acquisitions occur when a company attempts to take control of another, without board approval or management consent. Acquisitions often require significant financial investments and thorough due diligence to ensure long-term value creation. Outsourcing. Hiring external parties to perform tasks or services. Outsourcing manufacturing operations to low-cost regions helps companies remain competitive in price-sensitive markets. Critics argue that excessive outsourcing can lead to job losses in local communities and weaken organizational control. Workforce. The group of people employed by a company. Technological advancements require companies to reskill their workforce to stay competitive in increasingly automated industries. Investing in workforce training programs enhances productivity and equips employees with the skills needed for evolving industry demands. Leverage. Influence or power used to achieve a desired result. Strong brand equity can provide companies with significant leverage during negotiations with suppliers or distributors. Leveraging advanced technologies can significantly enhance a business's operational efficiency and reduce long-term production costs. Consumerism. The practice of buying goods and services in large quantities. Mass consumerism during the holiday season significantly boosts sales for retailers, but creates logistical challenges in supply chain management. Critics argue that unchecked consumerism encourages wasteful spending habits and overproduction, harming environmental sustainability. Royalties. Payments made for the use of someone's property or work. Companies that license patents from inventors often pay significant royalties to use their technology commercially. Digital platforms enable musicians to earn royalties directly from streaming services, transforming revenue models in the entertainment industry. Emerging market. Economy that is transitioning into a developed market. Emerging markets provide lucrative opportunities for businesses due to their rapidly growing economies and expanding consumer base. Companies entering emerging markets must adapt products to meet cultural preferences and varying levels of purchasing power. Fiscal year. The 12-month period used for accounting purposes. Companies evaluate financial performance annually, aligning budgets and strategic goals based on fiscal year-end reviews. Investors scrutinize fiscal year results to assess profitability, revenue growth, and operational efficiency before making funding decisions.